video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Alright, hello and welcome to Camel Finance. I'm your boy Camel and welcome to the weekend's deep dive. On the weekend, we like to come back and reassess the base case hypothesis of the channel, check for invalidations, and largely speaking, I just want to know if I can continue to have confidence in my overall positioning and posturing. So, as ever, we're going to run through this from the top, take it one bit at a time, and see if we can continue to have confidence in our posturing and in our assessment. So, for the stock market, the base case was pretty simple. At the lows, we were too bearish. We were going to have a blow-off top to all-time highs. They would see the onset of a rate cutting cycle somewhere around the top. Then we would enter a global bear market recession, and there would be a deflationary component with this. And of course, if there's going to be a recession, then we would also expect to see labour market deterioration and the consumer damaged and all that kind of thing in here. Something else that was interesting about this is that I have been suggesting that the high, once it comes in, may well remain the high for a lost decade while we experience a sideways consolidation and congestion in here, just like we saw in the prior times, whilst the oscillator down the bottom resets itself. Fast forward to today, and as you can see from the chart, so far so good. The thing looks like it is in the middle of a third and final blow-off top angle. We, of course, have already seen the onset of the rate cutting cycle. But largely speaking, it's difficult for me to look at this and say anything other than it's going, roughly speaking, according to plan. For Bitcoin, the idea was fairly simple. It was that, similarly to the stock market, it was going to have a big blow-off top to all-time highs. I thought this cycle would be slightly different. I thought we would get an all-time high before the halving, and here's the key part, a left-translated cycle top, meaning the top comes before November of this year. I will say this thing is half right. This has been the one component for me that hasn't quite played ball. We did really well at getting to here, and then we spent way longer consolidating than I was expecting. So here is that chart, as you can see, and largely speaking, it wasn't too far from reality. The good news is we now appear to be breaking out, and so I am more than happy if something like this is going to occur just slightly later than anticipated. I do think it is safe to say at this point that we are likely not going to get a left-translated cycle, but having said that, it is still my base case that we are going to see this top come in earlier than normal. And therefore, we should expect something akin to this, followed by an extended period of bear market decline. I am expecting more than the 12 months we're used to seeing for Bitcoin. As ever, I am open to being proven wrong about that. But my current base case is that we are currently undergoing something akin to this, meaning we should start to expect fireworks for Bitcoin almost immediately here, and anything other than that will be invalidation for me on this idea. I am also more than happy to call a top in gold at the moment. I think gold has topped for the weekly cycle. I think we can expect gold in blue to decline, just like it did in the prior times, into its weekly cycle lows. And notice how Bitcoin, in each instance, arose and broke out from a consolidation and moved into an expansion and a parabolic upthrust. So that is exactly what I'm expecting to see over the coming weeks. Inflation for me is going to be very, very, very important. We've got CPI print coming out this week. I've long been making the case that anything you do to the M2 rate of change shows up in the CPI, albeit with a lag. And I've been making the case, therefore, for a long time that we had this down, sideways wobble, and down in M2 rate of change, and that would show up as down, sideways wobble, and down in the CPI print, albeit with a lag. All the way through this middle period right here, the market was 100% convinced of itself that inflation was sticky and that a resumption was to continue, and we were saying, no, 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 this part of M2 rate of change has yet to show up. When we hop into the inflation data, an updated print, you can see down, sideways wobble, and here's the key part, we have started to resume down. Now, the reason I say this week's going to be so important and so interesting for me is that we are going to be getting a print that is somewhere close to below 1% region according to Trueflation. So I still very much expect to see inflation drop off like a stone right here in line with that M2 rate of change snapback. But where this starts to get super interesting for me is afterwards, we're probably going to see at least a temporary bottom come in for inflation. And the reason I say that is because the current updated version, this is around 1 month ahead of the government US reported rate, as you can see, has bounced all the way up from the low 1% to now 2.6%, which makes me wonder if we're going to get a shockingly cold surprise downside print followed by a big counter-trend bounce. As ever, we'll keep taking it one day at a time, and I still maintain that the real risk here is deflation. If we see something like this following this shockingly cold CPI print that I expect this week, and then something is to break, and the stock market is to come crashing down from its third and final blow-off top angles, then we absolutely could see the beginning of a deflationary type bear market. So whilst I am very, very long, strong, and bullish in the short term, I am also increasingly bearish under the hood. And as I said, this is going to be a really, really interesting CPI print for the Camel Crew. Another core component of this hypothesis was that right around this time, if we're going to have a bear market and a global recession, then shouldn't we expect to see labour market deterioration? And of course, that's what we've been seeing. Most recently, we saw the non-farm payroll data flip into negative territory. Now, note the subtleties. Last time we saw this, in both 2007 and 2000, there was one final high left in the stock market. Are we about to see this being put in right now as we speak? Are we getting that one final high before we get non-farm payrolls continue to turn down and the stock market finally break down from that third and final blow off top angle? We've got another nice chart here from Brett. As you can see, job openings in black sharply down, continued jobless claims in blue turning up, and unemployment rate in red also trending up. Not the kind of look you want to see if you are convinced there is no chance of a recession anytime soon. And as if that data is not bad enough, take a look at the total revisions. Down the bottom, approaching nearly 500,000 revisions to the downside. So the jobs data is actually a lot worse than they are letting on, as if it's not bad enough already. The SAM recession rule is now back to printing below the 0.5 threshold to trigger a recession indicator. However, if you look at the hard right edge, that is undeniably an uptrend of higher highs and higher lows, which I do expect to continue in the not too distant future as well. Be interesting to see the next print of that. And of course, right around the time that we expected to see those rate cuts, we saw this week an additional 25 basis point cut, and we are now around 68.1% probability of seeing another 25 basis point cut in December's meeting. We've done a very good job at tracking this. We were tracking this the whole way. Each one of the blue vertical lines denotes the time when the Fed funds rate moves above the 2-year yield, and we use this to accurately call for a pause in the Fed funds rate. And then we were monitoring the green, which is the US 2-year yield, stating that when this thing turns down, it usually leads to the onset of a Fed cutting cycle. And monitoring the 2-year yield turn lower, of course, enabled us to see the Fed funds rate move lower as well shortly thereafter, so we were able to nail the onset of the cutting cycle there. But here's where things get quite interesting. Here's an updated chart. So we have now seen a 50 and a 25 basis point cut take place, hence the orange line turning down. And despite the massive counter-trend bounce that we have seen in the yields of late in green, notice how this is still quite clearly a succession of lower lows and lower highs. Again, green moving down, expected to continue to move down as the onset of the cutting cycle continues. And of course, the subtle nuance here is that cuts into normalization are bullish. But I have been making the case that this is not what we have, and in fact, we have cuts into a slowdown. And each time we see cuts into a slowdown, it typically coincides with major stock market tops, large bear markets and drawdowns, and most importantly, oftentimes global recessions. So not only have we got the Fed behind the curve, we also have the Fed behind inflation. That's to be confirmed this week. And we have the Fed lying about the unemployment data, trying to make it seem like it's not as bad as it really is. All the while, the stock market is tricking investors by going parabolic into thinking that everything is fine under the hood, when in fact it is not. And this is how multi-decade cycles come to a climax. To show you why I am so concerned about these cuts, again, I make the case these are not cuts into normalization, these are cuts into a slowdown. The yield curves are reverting, as I'm about to show you, and all I keep hearing is, we are early in this bull market. We are in the early stages of a melt-up. Well, if that was true, tell me what you see here. At the top, we've got the 10-year, 2-year yield curve, which I consider to be a leading indicator. It tends to revert back above the zero line and then accelerate ahead of time, a little bit ahead of the 10-year, 3-month yield curve. But note what happens every time. We break down, the yield curve inverts below the zero line, it then reverts and accelerates, and that coincides with major tops for the stock market. We see the same thing here. Yield curve inverts, reverts, and accelerates back above the zero line. That coincides with a major bear market and global recession. We saw the same thing here. We get the C19 plunge. And what have we got today? We've got a backdrop of allegedly the early stages of a bull market with a yield curve that has been inverted for a record number of days and is now reverted back above the zero line and starting to accelerate. Like I said, this is the 10-2, which I consider to be an indicator, a leading indicator of what is to come. But if you want the signal, then I believe we should be using the 10-year, 3-month, which, as you can see, is not quite reverted just yet, but is soon to come, in my humble opinion. And as it does, alarm bells should be triggering, because when this occurs, it usually means that the top in the markets is very close. And fitting in with this theme, that the Fed is already too late and too slow to react, what we have here is the 2-year yield minus the Fed funds rate. You can see the Fed fell all the way to about 160 basis points behind the curve. And since then, we are seeing this thing become normalized and start to move back to the upside. And you might be thinking, oh, happy days, except the prior instances that we saw this, the Fed becomes massively behind the curve, over 160 basis points behind, and then a snapback. Look at the timing for this. It coincides with the GFC. And we saw the exact same thing here, all the way to about 150, 160 basis points behind the curve, a snapback, and that takes place with the dot-com bubble bursting. So once again, I make the case that we're about to see this thing snap higher as the third and final angles for the stock market get violated to the downside and we enter those bear markets and global recessions. And remember, all of this is against the backdrop at record high US credit card debt, as you can see right here. And of course, personal interest payments at huge levels in the face of personal savings rates down at lows. So the consumer is in very bad shape. It is the consumer that drives the business cycles, and if the consumer has not got much money, then how are we going to avoid a recession? That is the case I've been making over and over again. And so moving into the charts, herein lies the issue for me personally. I have been trading in and out of this thing publicly the whole way up. We are currently still having gone flat just before the whole yen carry trade unwind, rocking with a couple of long positions on the S&P. I'll show you the rest of the live positions soon as well. And the tough part for me is I am conflicted between my macro assessment and the charts in front of me. So as you can see, based on everything I presented today, the macro backdrop seems to be pointing towards a recession in the not too distant future. So there's that. But on the other hand, the whole idea of this was we were going to get these 3 angles and a big blow off top, and that's exactly what we've got. Now, there's absolutely no rhyme or reason for me to stop trading this trend to the upside. There's no rhyme or reason right now in the charts for me to exit the market. The market continues to print higher highs and higher lows. It continues to obey and respect the third and final blow off top angle in the stock market. And as of Friday's candle, we actually touched 6,000 on the S&P for the first time. So do I want to be selling out here just because the assessment says a recession is around the corner? No, I'm going to continue to remain long and strong, albeit with bearish internal conflict at the same time. I am more than happy to be wrong about the recession. I'm more than happy to be wrong about this whole bearish feeling on the inside. But one thing I don't want to be wrong about is staying on the right side of the trade. So for now, I'm still long and strong and bearish all at the same time. It's kind of a weird posture, but that's what we're doing. And it doesn't feel good right now. The higher this thing goes towards the end of the year, then the more I'm going to be thinking any breakdown is an exit signal and a top signal for the market. As I said, there's just no rhyme or reason to doubt this trend or to try to fight this trend at the moment. So long and strong there. It was a similar deal for the NASDAQ, closing in at all-time highs. We've, again, been trading in and out of this thing the whole way. We went flat just before the whole yen carry trade unwind, and now we're back in and capturing what I believe is a third and final push to the upside. The Dow Jones as well, again, went flat before the yen carry trade unwind, got back in once the risk had unwound a little bit, and here we are, pushing new all-time highs. Again, do I want to be trying to fight this trend, trying to doubt it just because I think a recession is coming? Do I want to be fighting this trend just because I feel bearish? Absolutely not. We're going to keep long and strong until the charts break down of their third and final angles, and most importantly, confirm that with failed daily cycles. The setup, however, is somewhat alarming to me. We've got this VIX on its way down to new lows, I believe, and then out of there I am going to be wanting to put some hedges on so that I can catch any third and final angle breakdowns in the stock market should they occur. And similarly, the Russell 2K on its way to 2,700. So who am I to argue with this? Long and strong, even though I'm bearish, I am thinking that any kind of breakdown from this kind of neighborhood would be me thinking that is it and the top is in for this market. For now, long and strong continue to push there. I am thinking the top is in for this weekly cycle for gold now. I am thinking that's the top. I'm thinking we're not going to trade above it. We have got a daily cycle low, and some kind of counter trend bounce here makes sense, but then I expect this cycle to fail and head it down towards that weekly cycle low time frame. Same for silver and the miners. Out of that weekly cycle low time frame, I think it will be a huge opportunity to get behind a bunch of metal and metal mining positions. And Bitcoin, of course, we are still long from the cycle low back here. We continue to push. We've got a new daily cycle ahead of us. And one thing I am noting on this all-time high break is there is a huge amount of bearishness. There's a huge amount of doubt. There are massive accounts calling for new lows. There are a lot of people underexposed to this move. A lot of people asking me, can I buy this now or whatever? And that is frankly the absolute perfect backdrop for an all-time high breakout. It is malpractice to be bearish here. I'm noticing people are begging for a pullback to get in because they don't feel comfortable chasing this move higher. And I understand I probably wouldn't want to buy here either. But the reality is, okay, this is a move into price discovery. We're spending multiple daily candles here. Some kind of bull flag and a break to the upside is probably expected, especially with the backdrop of everyone doubting it and everyone being bearish. And I see a lot of people in my comments saying, no way, this is going to new lows. And I don't know what they're looking at. Personally, I don't see it. This is an all-time high breakout, and for me, the thing is super duper uber bullish right now. So long and strong there, and of course we've been capturing this via some crypto-related stocks in the members section, and we're going to continue to do that because they are outperforming Bitcoin and many of those altcoins at the same time. And of course, you don't have to take nearly as much risk there. And fitting in with this theme of long, strong, and bearish, it looks an awful lot to me like we have found a 3-year and a 15-year cycle low for the Dixie. It looks an awful lot to me like this current cycle is probably going to continue to push and right translate. And if it does, that's absolutely confirmed as a 3-year cycle low and a 15-year cycle low. That's the bottom of the Dixie, and we are probably going to see this big push. And of course, I've been making the case the entire time that the only way this occurs is with the stock market breaking down from its third and final angles. Of course, needless to say, we have that. We have the stock market in a third and final angle. This cannot be sustained forever, needless to say. Maybe weeks, maybe longer than I anticipate for sure. But at some point, this is going to come tumbling down. And when it does, expect, number one, that to happen very quickly. And number two, that to put an enormous bid under the dollar and continue to drive what I believe will be that deflationary bear market. So again, long and strong because there's no reason not to be. But at the same time, the dollar breaking out, and if it starts to right translate daily cycles together and roughly follow my yellow squiggle, then again, I make the case alarm bell should be ringing here. And once more, note the backdrop here. Everyone calling for this to be the top and it to roll over and make new lows. Well, it doesn't look like it right now. For that to be on the table, we need this current daily cycle to left translate and fail. And of course, if it doesn't, if this right translates and then bounces, then that's it. That's it. The bottom's in the dollar. No one's getting the sub 100 level. And we are probably going to be moving towards a deflationary crash. And again, all of that really fits. It fits the expectations. Blow off top in the stock market, dollar to find a low, and have this big deflationary bear market. So it's a weird posture to hold. It's super, super weird. I am super macro bearish. I'm super long-term bearish. I really think when this thing comes down, it's going to be really severe. Way worse than GFC and the dot-com bubble unwinding because there's just so much more leverage in the system. Again, there's no reason not to be long and strong right now, so I am. I'm going to ignore my feelings and wait for the charts to tell me when to leave the market. Notice how the yields are right into resistance. This has been a big move. We did well at calling this yellow squiggle to the downside, and then what we got is this big violent counter trend rally. If it's going to reject and roll over, happy days. But again, any kind of breakout here and alarm bells should be ringing for sure. So as you can see today, not a great deal has changed. Still long, strong and bearish at the same time. Still waiting for that CPI print to come in. It should be cold, and then after that we might have a little bit of headwinds, at least for my base case hypothesis. We'll take it one day at a time as always. Unemployment continues to deteriorate. I don't expect that to change. The consumer continues to weaken. I don't expect that to change. The stock market is indeed putting in a third angle. Happy days. And Bitcoin is on its way to a big breakout. I'm sure of that. And then of course the question becomes, how high can Bitcoin go? And still the focus for me is on finding these tops. I don't want to leave the market just because I've got a gut feeling. I want to wait for the charts to break down and get out at the tops, and then we can talk about protecting the capital and the content. Once the top is confirmed, we'll switch to how to protect and preserve capital in these kind of major downturns and recessions and bear markets. But I don't want to spend any time on that now, because what if I'm wrong about all of this and we're just going to continue to rip for a year, 2+ years? Then happy days. We'll just come on here every day and say long and strong and bearish. And it is what it is. So I hope you found value here today. I hope you have a fantastic weekend. If you're a level 3 member, look out for the members video. And other than that, I will see you on Monday. All the best. Cheers. Bye.
Camel finance, he's the man to see. Rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame. Sticking to his guns in his money game. He's a badass, oh yes indeed. Camel